Today we're going to be talking about tax loss harvesting. So there's a few initial things you're going to want to know about tax loss harvesting. The first thing is that you have to do it in a taxable brokerage account. You can't do this in like a 401k or a Roth IRA or any kind of IRA. So that's the first thing. The second thing is that what tax loss harvesting is you're capturing the loss of a sale of a security during a market downturn, and you're basically capturing that for tax purposes, but you're not actually realizing the loss in the sense of you're going to maintain the same market exposure, and I'm going to explain how to do that. So first you would take your, let's just say, Vanguard S&P 500 index fund, and you would sell that. So you're going to take the loss, and that's going to show up on your tax return. And then you're going to immediately go and buy the S&P 500 fund from another company like, say, State Street. And so what that does is it protects you from the wash sale rule, which I'll talk about in a second. But some great things you can use tax loss harvesting for are deductions on your current income tax return. You can deduct up to $3,000 of capital losses on your tax return. So that's obviously important for people that need tax deductions. And then the other thing is these losses in excess of the amount $3,000 that you can deduct on your tax return get carried forward indefinitely throughout your life. So we like to build these credits up, and then if you have something like the sale of a rental property or a vacation home that has a capital gain on it, you can actually use the capital losses that you've had to offset the gain on that sale of property. So it's very powerful in that way, because you can just be building these up as you manage your portfolio in the background, and then when you have the sale of something like a rental property, you can then use that to offset capital gains. So some considerations for tax loss harvesting that you'll want to be aware of is the wash sale rule, like I mentioned earlier. And what that is basically, if instead of, like I had said earlier, where you bought the Vanguard S&P 500 fund or sold the Vanguard S&P 500 fund and then bought a S&P 500 fund from another firm, if you buy and sell the exact same security, that's a violation of the wash sale rule, and we don't want to do that because the loss is disregarded, and then basically your tax loss harvesting is for nothing. The next thing is the capital loss carry forward that I was talking about. It only lasts throughout the duration of your life. So if somebody's older, they may not want to tax loss harvest because they don't get to keep that for their descendants, and you get a cost basis, a step up in cost basis when you pass away, which is actually a very powerful aspect of taxable accounts. But tax loss harvesting doesn't help you in the event of you passing away. So it's not for everybody. If you're thinking about tax loss harvesting, we highly recommend seeking advice from a financial advisor. And if you think you need help with this, then we'd be happy to help you at Wiser Wealth Management.